The third candle in any fair value gap is the most important one because it will tell you if that fair value gap will actually hold, if we will retrace back deep into that fair value gap, or if we will not even retrace back into that fair value gap at all. Let's first understand that the fair value gap is a 3-candle pattern. So we have the first candle, which is the least relevant one. It doesn't really matter what the first candle is doing. The second candle is always going to be an expansion phase because if we have a bullish fair value gap, it's going to need to expand above the first candle high, creating the body which will be the actual fair value gap itself. Now the third candle is where it gets tricky because the third candle has 3 different options which all tell you different things. The first option is a deep retracement. So if we take a look at the dollar, here we are on the monthly time frame. The first target we established in previous videos as well as the previous month's low right there. Once we reach that target and we go down onto the weekly time frame, and by the way, this again is completely fractal, works on every single time frame, every single market. Then we see once we reach that target right there, we are in the midst of creating a fair value gap right there. But what can we also see? That we have the first candle, perfect. Second candle, expansion phase, perfect. Third candle is an extremely aggressive move higher. It's a deep retracement. There's a lot of resistance once we reach this target. There's a lot of resistance going higher right there. So the way I want you to see this, I want you to imagine right now on your screen a pushing battle. We have a bearish person and a bullish person right there, and they're both trying to push price lower and higher. Now, when they both push very strong, that might lead to price not going anywhere, right? Because if they both push hard enough, price is just going to stay in the same place. But if one pushes harder than the other one, so the bearish person pushes a little bit harder than the other one, that in the first place is going to create potentially a fair value gap because there's bearish intention, which creates the second candle, the expansion phase candle of that fair value gap. There's the bearish person pushing price lower, but then the bullish person, whilst coming into a discount rate like the previous month's low, is pushing price higher very strongly as well. And how do we know that price right there is getting pushed higher very strongly? Well, if we first look at the complete expansion phase that we had, we could have created a complete fair value gap like this. If the third candle would have just already been completely out of the open, a bearish candle, which it does not do. On the next candle, it instead pushes higher. There's a lot of resistance going against us. There's a bullish person right there pushing that price higher aggressively. Now, when we push price higher aggressively on a third candle, what does that mean? That means that we in the first place might actually create a smaller fair value gap than expected right there. But more importantly, there is a lot of bullish momentum going against a bearish fair value gap. So the analogy I always like to use is it's like a train right there going into that bearish fair value gap, and there's a mouse, a small little mouse trying to stop that train. That's not going to work. It's again that pushing battle. They're pushing back and forth. So if a third candle has an aggressive move against the original fair value gap, in this case, an aggressive move higher, bullish momentum, my first thought process is that fair value gap is not very likely to hold. It's not the highest probability fair value gap. And the highest probability fair value gap is the third option that we are eventually going to go over. If we do want to hold right there, then we will most likely see a deeper retracement into the fair value gap, potentially coming into something overlapping, so an order block, a breaker block, to then continue lower. Why? Well, very simply said, because again, it's a pushing battle. If we have a lot of momentum going against a certain fair value gap, we can't expect that fair value gap to just all of a sudden magically stop that bullish momentum right there. It's not going to work. We can't expect that small little mouse to stop that train coming at it. Now, why is that then important to understand? Because once we sting into that weekly fair value gap right there, if we were to go into any confirmation time frame, then people might see already sells right there to continue lower. But that's not a good sell opportunity because we have a lot of momentum going against it. So what do we want to wait for? We want to wait for more confirmation instead if we do want to continue lower. And that leads back to the basics of understanding trading. If we want to be profitable, we don't want to take a lot of losses before we take the next winner. Because if you target a 1 to 2 RR and you take 2 losses right here before you might actually catch the huge winner and we continue lower, then that means that you are break even. Now imagine if you catch 3 losses before you catch the huge move lower, for example, right there, then you are catching a winner, yes, but you are unprofitable. So if you're targeting 1 to 2 risk to reward ratio, then ideally only 1 loss before we take the winner. And in an ideal world, of course, 0 losses before we take the next winner. And if we want to take 0 losses, then there is no shame in just simply waiting for an extra fair value gap lower. And what I mean by that is, instead of your usual entry confirmation, wait for a little bit more than usual. So instead, wait for a 4-hour fair value gap, for example. And off of that 4-hour fair value gap, we can now look for new entries to continue lower. So the first option we just discussed, the deep retracement option, is the lowest probability fair value gap we can actually look to trade off of. Now the second option is already a little bit higher probability to actually look to trade off of, which is the expansion option. The expansion option is also known as a breakaway gap, where again, in previous videos, I mentioned if we close above the second candle high right there, that in itself is, as a general rule of thumb, a breakaway gap. That is true, but there is a lot more advanced details that we can go over to see if it is actually a breakaway gap. So the second option, the expansion option, is where we have the first candle, again, can do anything it wants. Second candle right there is again expansion phase candle, creating the actual fair value gap. Third candle is also an expansion, so it's already continuing higher. When we have this, we can confidently say that this fair value gap is a breakaway gap and we will not trade back into that before we actually reach this draw liquidity right there. So what would you want to do? You would want to look at the lower time frame, so going into a time frame below it, to then look and find new fair value gaps which have the third option, which we're going to go over next. Now, this breakaway gap is quite obvious. Looking at Australian dollar, Canadian dollar right here, I can confidently say we are most likely going to deliver right there into the drawn liquidity from that high before we actually retrace back into that fair value gap. And if we do retrace back into that fair value gap, into that breakaway gap, then most likely we are going to see lower prices because it should not retrace that far. Similar to Australian dollar CHF right here, we have that swing high as the current target for the remainder of this week as well. We are leaving behind these fair value gaps. Again, we are most likely not going to trade back into that fair value gap because it is a breakaway gap. The third candle is an expansion phase higher right there. So what we want to do is ideally find a lower time frame fair value gap, which we can already look to continue higher off of instead. But this is quite obvious. What I just told you is not rocket science, but what we do need to go over is candle science. We have those very obvious breakaway gaps, but we also have the sneaky breakaway gaps. And the sneaky breakaway gaps, to master those is where you also need to master candle science. So if we take a look at this example on crude oil, we had this as target after sweeping this discount rate, that swing low right there. It was the only discount rate that we can still continue higher from. So that right there is what we mentioned in the forecast on YouTube as well. We can continue higher off of that. Then on the 4-hour, if we wait for a 4-hour fair value gap higher, then what do we see? Well, we have this 4-hour fair value gap right there. As soon as this up candle right there closes, and that creates this breakaway gap. Again, the third candle just being expansion higher. But then afterwards, we create a new fair value gap. And this fair value gap right there is showing, or if you know the general rule of thumb, if we do not close above the second candle high right there, we might want to trade back into that fair value gap to then continue higher off that. But that is if we do not understand candle science. Candle science is the following. In candle science, we have a disrespect candle and a respect candle. Very simply said, for bullish examples, just inversed for bearish examples. For bullish examples, if we have a respect candle, we have a long wick at the bottom of that candle, indicating that we are respecting something. Because what is that wick on the lower time frame? On the lower time frame, that long wick at the bottom is actually fair value gaps already pointing higher. Where a disrespect candle is, for example, this earlier third candle we saw right there. No long wicks on either side of the market, just a steady full body up candle right there. That indicates that on the lower time frame, we also have fair value gaps already pointing higher. So whenever we have a long wick right there at the bottom, what is that actually? That is actually a fair value gap on the time frames below already getting respected. So if we drop into the 1 hour right there, we see a fair value gap on the 1 hour right here already getting respected, meaning it's already been traded into, to then create a new 1 hour fair value gap right there. So at the moment, whilst we have a 1 hour fair value gap sitting right here, and on the 4 hour, we have this 4 hour fair value gap sitting right there. Is it realistic at this moment in time, whilst we have this drawn liquidity sitting right there, which we most likely want to deliver towards fast, because price action delivering towards a drawn liquidity always happens fast. High probability conditions happen extremely fast. So we might not want to retrace very far. Where here, again, the pushing battle, right? We have that bullish person is extremely bullish. It's pushing very hard. But the bearish person is not having a lot of resistance. It's not pushing back a lot. So it will not retrace a lot. So if the third candle is one of the respect candles that we see in candle science, then that creates a breakaway gap. Similarly, we see before we reach that low actually right there, we see another breakaway gap sitting right there as well, where the third candle is a long wick at the top and it's a down candle and close below the second candle low right there. Perfect. We can already continue lower without retracing back into that fair value gap because it's a breakaway gap. Now, a little golden nugget in between, if you truly want to understand candle science and fair value gaps, do you know ICT's term immediate rebalance or even a redelivered rebalance? All that is a fair value gap on the lower time frame. For example, right here, when we do not create a new fair value gap right there, but we do have a long wick at the top right there, that still indicates that we can continue lower towards that low right there because we're already respecting a fair value gap on a lower time frame. That's why we create that immediate rebalance right there. So we understand that this fair value gap, which is now a breakaway gap, we most likely do not want to trade back into that before we actually look to continue higher. This is where we will go into a time frame below it to find a new fair value gap to continue higher off of that. And that fair value gap is actually the third option fair value gap. The third option fair value gap is the highest probability fair value gap. We have gone over two options thus far, the deep retracement and the expansion. They are both the opposite. So they have a pull and a push. Those are two extremes, either huge retracement or no retracement, and we just continue higher. In the middle right there, we have balance. We have a consolidation third candle, where there is a lot of one-sided momentum right here on crude oil to still continue higher towards that target right there. But we consolidate with the third candle sitting right there. And the third candle here is not a huge retracement, is not an expansion higher already, relatively seen to where the full expansion phase could have been created right there. It is leaving behind for that full expansion phase almost 50% of the expansion phase. So that creates right there a third candle consolidation. Perfect. Since we are still so bullish, that consolidation is setting up perfectly to actually trade back into that fair value gap, to only have a sting into it, to then immediately explode higher after that as well. That is exactly what we see right there. And afterwards, if we do follow the 1 hour fair value gaps, what do we see again? Right here, we see the exact same consolidating third candle right there. Before, we have a sting into it right there, and then we continue higher off that towards the draw on liquidity right there. Remember the US dollar right here, where this fair value gap is the first option. It's a deep retracement most likely, or it will just simply not hold. Since we are expecting that, if we go into the 4 hour right there, what do we actually see? We try to reject off that weekly value gap initially. We fail to do so, create a new 4 hour value gap high right there. Third candle, what is it? Consolidation. Only a sting into it to then continue higher off of that immediately. So if we think this through, then there's another important aspect, which is arguably a huge underrated aspect, is we have something called the tricky third candle. And the tricky third candle is if you are, for example, right here on the daily time frame, and you are trying to trade this fair value gap lower off of that right there, then that fair value gap lower can indeed deliver lower. No worries, it can do that. But we need to keep in mind, at that moment in time, we are also creating the third candle, and we are trading the third candle of a fair value gap being created. Where if we are trading the third candle, we don't necessarily have a good idea of what it is going to do. Where if we're trading a second candle, we understand that's most likely going to be an expansion phase candle. But the third candle has three different options. It has the deep retracement, the expansion, and the consolidation, where 2 of those 3 options are not good to trade. The deep retracement, I would argue at that moment in time, is not really good to trade. We'd rather have it continue lower. Consolidation is also not the best to trade right there. So if you are looking to trade a third candle of any fair value gap that is about to be created, you are essentially betting on that third candle to be an expansion phase candle and to be a breakaway gap eventually. So that becomes a little bit lower probability. Can you still trade that? Yes, for sure. But you need to watch out for the first signs that might be there that we do not want to continue lower, which is where you need to pay attention to a sweep versus a run on liquidity. For example, that previous candle low right there, we sweep that liquidity and we do not run that liquidity. That indicates that we do not actually want to continue lower immediately. So watch out, same for the daily right there. If we create a daily fair value gap lower, watch out when you are trading the third candle. You can trade it as long as you understand a sweep versus a run on liquidity, which by coincidence will also be the next video that we are going to go over. In preparation for that, you can also watch previous videos that I made on similar topics like that. For example, I have made the sweep versus the run on liquidity video before, but in the next one, we will go into more detail. All right, perfect. Thank you.